Okay, welcome everyone. This is Scott here again with another video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And for today's video, I'll be discussing whether or not you should be trading spreads or spread-based strategies on very high implied volatility stocks. So that includes strategies like debit spreads, credit spreads, Iron Condors, ratio spreads to some extent, etc., etc. And so once again, I have the GameStop chart pulled up here. I've used this stock a few times in the past for my other videos because it definitely provides a great case study for a variety of lessons. Now before getting started here, for those of you who are new to the channel, I just want to let you know that I do also teach on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check those out, and when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. And now let me direct your attention to this chart down here at the bottom. And let me actually expand it up a bit so you can see it better. There you go. So if you have seen a few of my other YouTube videos, this chart should look familiar. This is just showing you a 1-year time series of the implied volatility for GameStop stock. Right? And if you recall, implied volatility is simply the market's expectation of where a stock will be at some point in the future. So as of right now, the implied volatility for GameStop is just under 200%. You do read this as a percentage. So this means 1 year from today, the market is pricing in the possibility of GameStop stock either tripling in price or going down to zero. So needless to say, this is a very volatile stock. And for obvious reasons, given the short squeeze that we all saw just a few weeks ago. And actually during that time, during the main short squeeze here, the implied volatility got up to just under 600%. So again, very, very volatile stock here, which does means the options on GameStop are very expensive, and therefore it could be advantageous to be selling them specifically, but you're really only going to be able to do so with naked options. As you'll see here in a minute, defined risk trades, credit spreads, debit spreads, Iron Condors, like I mentioned, it's going to be extremely, extremely difficult to make a profit on these kinds of stocks with very, very high implied volatility unless you hold that trade all the way until the expiration and you are also directionally correct. So why is this? Well, let's come over to the trade tab now and take a look at the option chain on GameStop, and we'll go into the May expiration cycle here, and I'll scroll down just a little bit. So as always, on the left hand side here, these are all the call options. On the right hand side, these are all the puts, and then down the middle, these are all the strike prices. And so let's say I am bearish on GameStop because I think the current price of this stock at almost 160 bucks per share is just absurd. And like I said, given that implied volatility is so high and therefore making the options on GameStop so expensive, it would therefore be advantageous to be selling options. So with that in mind, let's say I want to sell a call credit spread on GameStop here. So maybe I choose the 175 strike call option to sell, and then I choose the 185 strike call option to buy. So let me set up this order so it's easy to see. So I'll go to sell, and then we'll go to vertical. And so that brings up the order down here. Sell 1 contract, 175 strike call option, and then also buy 1 contract, and it's going to be the 185 strike call option. There you go. And the credit I will receive for selling the spread is just under 300 bucks, so not bad. So what is the issue with this particular strategy? And the issue has to do with the deltas of the call options in my call credit spread. Right, you can see in this column right here, these are all the deltas for these various call options. And the delta for my 175 strike call option is 54, and the delta for the 185 strike call option is 50. And just a quick recap on what delta is in case you are unaware, delta simply tells you how much the price of the corresponding option will change for a $1 move in the price of the underlying stock. So in the case of this 185 strike call option, if GameStop stock moves up by $1, then this call option here is going to increase in price by $50. And then conversely, if GameStop falls in price by $1, then the price of this option will decrease by 50 bucks. And that's it. And so the issue that comes with very high implied volatility stocks like GameStop is that it takes a while for the deltas to actually change significantly as you move either up or down the option chain. Right? The difference between the deltas for the two options in my call credit spread here is only 4. Right? 54 minus 50 is just 4. Only 4 deltas. And as you can see, as I move my cursor down the option chain here, the deltas do not change by all that much. They do decrease as they always do the further out of the money you go, but it's still a very gradual decrease in the deltas here. And so why is that problematic? Well, it's an issue because in a spread strategy like this, when you are both buying and selling an option at the same time. The deltas for those two contracts are going to cancel each other out. So in the case of this call credit spread here, the total delta for this spread is only 4. And once again, it's because the delta on my 175 strike call option is 54, and you simply subtract from this the delta of the option I am buying, the 185 strike call option. So 54 minus 50 is only 4, and that is the total delta on my call credit spread here, which means for a $1 move in the price of GameStop stock, I would expect this spread to move in price by only about $4. Not 54 or 50, only 4. And these are just estimates as well. If GameStop were to actually drop by $1, the spread might move by only $2 or might move by $6. The point is though, for these very high implied volatility stocks, spread strategies like this, like credit spreads, like debit spreads, like Iron Condors, are going to move very, very, very slowly in price unless the stock has an absolutely massive move. And that's why if I did want to make the full $300 on this spread here, or at least a significant portion of it, I'm going to have to hold onto this spread for a very long time, likely very close to the expiration date in 40 days. And that's a long time to have risk on for a very volatile stock like GameStop. Now I do have defined risk on this trade, so even if GameStop were to triple in price by tomorrow and blow through my strikes here, in the worst case I would only lose about $700. But point being is if you do want to trade these kinds of stocks with very high implied volatility, then you will likely have to take the route of using naked options, either just buying a call option or selling a call option, because that will give you 100% exposure to the delta on that particular option. If I were to instead just sell the 175 strike call option and that's it, well, my delta on that position would be 54, not 4. So now if GameStop starts to move, the price of my position, this single naked call option, is going to move a lot more significantly than this call credit spread. So perhaps if GameStop falls from 158 down to maybe into the low 140s, which is not a big move, but in that case, I could probably take off this position, buy this call option back for a nice profit. Whereas for this call credit spread here, the price of this spread would not have moved by that much at all. And so I'm just going to show you this one example here in GameStop, but like I said, this does apply to the call debit spread, the put credit spread, the put debit spread, the Iron Condor, right? You can see on the put side here as well, looking at the deltas for these put option contracts, they're all pretty close to each other. They decrease at just a very slow rate. And so lastly here, just by comparison, let's look at a very low implied volatility stock. So let's take a look at Johnson & Johnson. And you can see right now the implied volatility for this stock is just over 13%. So this stock is basically the exact opposite of GameStop. And so now if we go over to the trade tab for Johnson & Johnson, and once again this is the May expiration cycle, you can see now just how quickly the deltas fall off. For the 165 strike call option, the delta is 32, and then if you just go one strike away to the 170 strike, the delta gets cut in half. Then if you go to the next strike, the delta gets cut in half again, and then again. And once you hit a delta of 2 or 1, it's not going to go much lower than that. So the point here is if I were to sell a call credit spread on this stock, right, let's say I sell the 165 strike call option, and then I also buy the 175 strike call option, so the same kind of $10 wide call credit spread that I used on GameStop, well, if my delta on the 165 strike call option is 32, and the delta on my 175 strike call option is only 8, that means the total delta for the entire spread is 24, right? 32 minus 8 is 24, which is 6 times greater than the call credit spread that I showed you on GameStop, which only had a delta of 4. So as Johnson & Johnson moves around in price, this call credit spread is going to have a lot more price sensitivity. Its price is also going to move around a lot more significantly, and therefore if you do get a favorable move in the stock, if Johnson & Johnson were to sell off in price somewhat significantly, then you could probably take off this call credit spread for a nice profit at that point in time, and not have to wait all the way until the expiration date or very close to it. So I believe that does it for this video. I hope this all made sense. And so in summary here, definitely don't shy away from very high implied volatility stocks, but if you do want to trade them with options, then you're either going to have to use naked options or very, very wide spreads. So that way your spread can actually have some significant delta to it. And of course, if you have questions or if you need clarification, then please let me know in the comment section below, and I'll be happy to help you out. And don't forget, If you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.